The portfolio had an amazing week. So pretty much everything worked. Neurotrope fell a lot. The rest of the shorts kind of hung in there, and the longs did really well. So up 1.4% brings us to 7.11%. And I did a little bit of statistics. 83% win rate. I've invested in about 30 securities this year, and we've had an amazing run. And the median IRR is about 75%, which is pretty amazing. So even though the portfolio's only returned 7%, the IRR has returned roughly 75%. And what that means, kind of interestingly, is we've got 7.11%, but you'd have to sort of triple that roughly for the gross exposure being so low. So the gross exposure is pretty low. And then you've got, we sort of had 4 out of 6 months. So let's see. So we're the adjusted performance for a year, now this is only half a year, would be in the 75% range. So pretty much the best investing I've ever done for these first few months. So some of y'all have been very lucky and watching this and saying, "Oh, Martin, you're doing so well. How could you be doing this well?" And the reality is this may or may not last very long. So we'll see if that'll continue. But I like these positions. They all make sense to me. I've vetted them very carefully. Hoping to add a few more interesting ones, like if Global Blood checks out, that could be a pretty big winner. I think Ironwood and Fibergen could be pretty big shorts that I have to look into a little bit more. I always want to invest more in these stocks, but it takes some time to sort of make sure that you feel comfortable with them. So Taro is also, I think, an intriguing long. But again, there's only so many hours in the day, and one has to sort of fixate on completing diligence, which isn't easy. So some of these companies have known for such a long time, it's a little easier, but something like an Avexis really takes an awful lot of time to get comfortable with. And something like a Macrogenics, again, really exciting company, would love to spend more time looking at it and learning about it. But again, only so much time in the day. I do have my startups to focus on. But one of the things, again, you might have seen this performance and said it's incredible. Again, assume that it's temporary, and I'll sort of revert to mean, if you will. But one of the things that comes up is how do you think about your portfolio? Now, 83% win rate is very uncommon, but Warren Buffett has a win rate similar to that, and it made me start thinking about something that I think the folks at SAC Capital or Point 72 or whatever they call it now think about, which is this wholly sort of triangle of how you frame an investor or a trader. So just on the S&P, my IRR is about 75%. The S&P is up about 10% this year. So you have to think about IRRs. I've only had this portfolio for 3 months, and the gross exposure is about a little less than half. For a while, it was about a third. So if you take an aggregate, it's been a really, really amazing portfolio. Pretty much every stock has worked. Like I said, 83% win rate. Very, very lucky for that. So anyway, hopefully that explains it to you a little bit more, Shlomo. Anyway, the triangle is interesting. The basic concept is that there's some 3 variables that explain all traders, and this is sort of what mine looks like. And so the idea is that the win-loss accuracy is actually pretty easy to succeed at if you don't make many bets throughout the year. So like for instance, if you pick 3 stocks for the year, you said, I'm going to short Snapchat, I'm going to go long Regeneron, and I'm going to short Neurotrope, that's going to have a 100% outcome. I mean, those are 3 relatively secure calls. Neurotrope is basically a fraud. Snapchat is very overvalued, and earlier in the year, Regeneron was very, very, very undervalued. So if you really focus in on a few stocks for the year, again, maybe you're not going to hit 100%, but something like 80% is very doable and achievable. Now, if you start trading a lot more stocks, say this is a healthcare and tech combined universe, that could be 2,000-3,000 stocks. And let's say you traded 500 or 600 of them. Well, you're not going to get a win-loss ratio of 83%. It would get closer to 50% or maybe even below 50%. And you can still make money below 50%. These aren't three, clearly you always want your win-loss as high as possible, but these are more three attributes to describe a trader, not to say that you want all three as big as possible, but there's always a slight trade-off. So throughput is sort of works on the other side of accuracy, right? You can turn over your portfolio and shove more capital through your portfolio if you focus on more stocks, but it'll hurt your win-loss ratio. It'll impinge on that. And so these two lines sort of go against each other. So this is like a Warren Buffett private equity style where I'm going to pick 5 or 10 stocks, or in my case, again, 20 or 30, but it's not 200 or 300. I don't enjoy the diversification of a lot of other portfolios. I've got a big, sticky 6% position that didn't look so great when Bloomberg's article came out. Avexis didn't look so great sometimes. So you're not always going to enjoy the benefits of diversification if you're going to focus on accuracy and pure success of your stock picks. Of course, the other concept is sort of how you stop out your losses. So if every time you're right by 10x, and every time you're wrong by 10%, and you have a great stop loss somehow, you can increase your throughput and your win-loss ratio basically doesn't matter at that point. If you're swinging every time you win, it's a home run, and every time you lose, it's not. Now, the opposite often occurs where wins are very small, losses can be very big. Say, like if you're writing vol, for instance, your win-loss ratio, I'll give you a good example. So vol writer is win-loss is 90%, and his turnover is infinite. You can write every option on the planet, but the problem is that the dollars won, dollars lost is very very adverse. So you can have a sort of two that are really good here, and this one being really bad because of the way volatility works. So if you just sell options, this is sort of where you're going to come out. You still might make money, but the concept is in essence you're just short the VIX in many ways. So in any event, that's sort of one sort of way to think about it. So this is sort of what mine looks like. This is more of like a high frequency trader or a quantitative hedge fund, has close to infinite throughput and velocity, but obviously the other way, there's so many different ways to make money, but this is sort of one of the ways to think about what kind of a trader are you, and how to maximize all three of these to get better success.